By Peril Rating is changing the game for insurers. One fundamental aspect of insurance is charging the correct premium for the exposure being underwritten. This means that the insurer needs to have a good understanding of the risk they're taking. Technological advancements have resulted in more elaborate and detailed methods of quantifying risk. The increasing use of predictive analytics tools, including By Peril Rating, has been a game changer. By Peril Rating is a tool that allows the insurer to analyze the individual characteristics and exposures of a risk on a very granular level. Insurers use a variety of methods to pursue their goals of increased market share, reduced losses, simplified underwriting, and claims handling. Some perils, such as named storms or floods, can be excluded altogether. Others can be mitigated using conditions and deductibles. Hurricane deductibles and actual cash value limitations on roof damage are two conditions that are commonly included. Historically, some risks, such as homeowners and small business owners, have been treated as one-size-fits-all. Early rating plans for homeowners and business owners policies were fairly simple. Premiums were based on a limited number of characteristics: construction, occupancy, protection, and exposure. Coverage under these programs was all risk, everything was covered unless it was specifically excluded. One reason for the simplified rating system was the lack of access to data. Compiling and analyzing results used to be cumbersome, expensive, and time-consuming. Simple rating plans assume that perils are impacted equally by the same factors. For example, a risk in the Midwest may have a higher risk of wind or tornado damage, regardless of being located in a rural or urban setting. However, theft and vandalism risk might be higher in a more urban setting. By Peril Rating breaks the types of losses that can occur into multiple categories. Insurers can rate a risk based on a more accurate understanding of the mix and magnitude of perils the risk is exposed to. The perils that are commonly included in By Peril Rating systems are fire, liability, theft or vandalism, wind, hail, weather-related water, non-weather-related water, lightning, and all other perils. As a case in point, two houses in the same neighborhood with the same replacement cost will have different exposures. For comparison purposes, look at two one-family houses built the same year. Both have a replacement cost of $500,000. House 1 is a 3-bedroom, 2-story brick colonial with 2 baths, a pool, and attached garage. The shingle roof is 15 years old. House 2 is a frame 1-story ranch with 4 bedrooms, 2.5 baths, and a detached garage. House 2 has a brand new slate roof. While the cost to rebuild after a total loss would be the same, the risk of loss varies. Dogs, pools, trampolines, and swing sets represent an increase in liability hazard. Brick houses are less likely to burn. Other characteristics of the homes may also impact the rate charged. Alarms, security systems, and cameras reduce the risk of theft and vandalism. Smoke and fire detectors impact the fire peril, lowering the rate. Water damage is an interesting peril as it can be due to weather or non-weather causes. So, water damage would be listed in 2 categories: weather-related and non-weather-related. In the example provided, more bathrooms in House 2 could mean a higher frequency of water damage, but multiple stories in House 1 could represent increased severity of damage from any one loss due to water from upstairs damaging lower levels. House 1 would also have a greater risk of weather-related water damage to the roof due to its age. Not every By Peril rating system is the same, as each insurer can have their own set of perils that are used in their rating system. As indicated, rates differ based on the individual perils the risk is exposed to, as well as the characteristics of the property itself, and 2 homes in the same neighborhood with the same replacement cost can have different rates under By Peril Rating. As with any rating methodology, developing the proper initial rate is only part of the battle. Collecting results to allow the company to respond appropriately to variance in risk and modify the rate accordingly is equally important. An insurer's data is only as good as the information collected. Using a By Peril rating system requires premiums and losses to be reported based on the components of that system. By Peril rating isn't just used for personal lines insurance. The business owner's policy has also experienced a major transition since its beginnings. Originally designed as a program for Main Street type, fairly homogeneous risks, the BOP eligibility classes have been expanded to include a wide range of risks with very different liability and property exposures. BOP policies can now be written for insureds with properties in multiple locations and even multiple states. This means that the same business, a clothing store for example, can have different rates under a By Peril system because there are different exposures in the various locations. By Peril Rating has increased dramatically in recent years, so has the collection of predictive analytics data and use of modeling and statistics to assist companies with underwriting, rate making, and claims handling functions. Together, By Peril Rating and predictive analytics have changed how the insurance industry can review and assess risk. The ability to use these practical applications in a statistically sound way helps to reduce risk and fraud. The use of By Peril Rating will only strengthen as the ability and accuracy of predictive analytics continues to increase. That's all for now. We have more content for insurance professionals on the way, so hit the bell to subscribe.